rental properties. Now, this has become a subject and topic that has attracted lots and lots and lots of Australian taxpayers over recent years, perhaps leading up to the COVID-19 pandemic. Now, why has this particular topic attracted Australians and potential investors? Well, it provides another source of income to most people, and to a lot of others, it provides what we call a negative gearing, which means it reduces the taxable income of high income earners. Now, at this stage, I need to remind you kindly that this is not a substitution for financial advice or any kind of advice. This is purely educational in providing taxation aspects of buying, maintaining and selling a residential rental property or investment property. Now, having said that, I do work in an accounting practice where a lot of our client base do have investments in residential and non-residential property, along with different business structures that they've put their investments in. If you would like to, send me a message on my YouTube channel or through Facebook, and I'll be happy to give you an appointment and to be able to provide a little bit more specific advice for your own individual circumstances. However, this tutorial is just educational. Now, in front of you, you'll see a Microsoft Excel sheet where I'll be guiding you through how to pretty much save some tax and money on rental property investments. So let's say, for example, you already have a rental property and you purchase this, let's say on 1st of July 2018, and the price was, let's say, 800,000. Let's also say you've taken a loan on property and the loan amount is, let's say, 600, and the interest rate is, let's say, around about 3.4%. Now, the interest expense on a loan of 600,000 at 3.4% per annum, you just do a formula. So equals this multiplied by 3.4%. So the interest expense you would expect is somewhere just over to $20,000 for the year. Now, let's say we're looking at the financial year ended 30 June 2020. Let's say you generated rental income of 25,000. Then you have interest expense for the year of 20,400, and let's say you have all the other expenses in relation to your rental property. So you have your outgoings like council rates, water rates, insurance, land tax, and so on. Let's say they amount to $6,000. So what you're looking at is your net rent, and I'm doing a formula here. So income minus the interest minus the expenses. So there's a little loss of $1,400. Now, let's say you managed to get a quantity surveyor and they've done all these valuations on your property and they provided you with what we call a tax depreciation report. Now, we do, in the accounting firm, we do recommend clients to have a tax depreciation report in order to provide them the maximum potential benefit in relation to the rental deductions. So let's say tax depreciation, we have depreciation on assets in property. Now, let's say this amounts to $3,000, and then you have what we call capital works. Now, capital works is usually 2.5% on the total cost of the construction. So, the property you purchased at $800,000 includes the value of the land. So, capital works basically takes out the value of the land and only includes a building value, and that's at 2.5% each year. So, let's say, for example's sake, the total capital works for the year is $5,000. So that's a total, if you do an auto sum of these two figures, that's a total depreciation of $8,000. Now, if you add that onto your already net rental loss, which is $1,400, the total overall loss will come up to equals that minus the $8,000, $9,400. Now that works pretty good if your individual income tax bracket is in around the 32.5% or the 37% or the 42% or whatever your tax bracket is. This net rental loss reduces your assessable income. And in that way, it can provide a potential tax saving for you of your marginal tax rate on that $9,400 rental loss. So you can see from this very basic example how a negative gearing can provide a tax saving for you. However, I need to mention this to you that negative gearing is not suitable for everyone. It may only be suitable for higher income earners who are looking to reduce their tax by way of investing in a rental property and applying a negative gearing to their property. Now, let's say the higher your interest is, the higher your rental loss is, and the higher the saving will be for you in the long run. But you probably won't want to continue having negative gearing over a very long term. But that's just one way of saving a tax in a short run.